Right now, we're going to welcome the host of one of those shows. Mike Baudendistal hosts the Stock Out and writes the Stock Out newsletter as well. CPG expert Mike, thank you for joining us on this Tuesday.
Hi, good to see you guys.
Good to see you as well. And of course, talking inflation, as Anthony likes to say, and it feels like we're kind of sitting on this economic precipice. Today, we're kind of talking about what that means for the CPG industry and CPG companies and consumers overall as well.
Yeah, I mean, last time I talked with you, we talked a little bit about, the biggest impact that I see happening with the war in Ukraine on the CPG industry, which is really just, the rising prices for agriculture as well as energy. I mean, energy goes into so many things that find its way into food prices, whether it's for the packaging or for the transportation costs or for the fertilizer. A lot of fertilizer is very energy intensive, but also concerned about related to a little bit of what we heard from Anthony just a minute ago, and what that analysts were talking about on the ocean side is related to demand. And are we going to see a global recession? Is there just going to be a recession in Europe and just a slowing of the growth rate? In the U.S., I think CPG companies and other companies are trying to think through those things. Certainly the stock market is discounting in a higher probability that you could see a recession. You've seen that all the indexes down, over 10% from their highs. And something I thought was interesting was a lot of the economists have already started cutting their forecasts since the war began. Saw a survey of 14 economists that took their GDP forecasts from, I think, 3.5% for the U.S. to 3.2%. Now, 3.2% is still strong, sort of above trend. But a lot of times with those type of forecasts, it's kind of death by 1,000 cuts. And this is the first cut in a series. And really, it's going to have a bigger impact than that. I've seen some forecasts saying that, well, the oil prices are going to hit U.S. GDP by 0.2 percentage points, the agriculture prices by 0.1 percentage points. But, that could, be an understatement if prices continue to rise. So as far as what this means for CPG companies, I don't know that the average person that buys Oreos is necessarily thinking about the GDP forecast. But what they do notice is that grocery prices are up 7, 8, 9% from where they were a year ago. And most actually, when they have surveys, they think they're up more than that. And I think most people see that gasoline is over $4 a gallon in most places. Last year was about $2.50. So that almost has an impact of, close to $1,000 a year for the average consumer that drives, let's say, 11, 12,000 miles. So those things have pretty big impacts on what consumers are willing and able to spend. And the phrase we heard over and over again from CPG companies is that demand has been less elastic than it has been historically. So, last year, CPG goods on average up about 5%, some a little bit higher than that. And they really hadn't seen much destruction in demand. But this faces a greater test now with prices rising further, and with these shocks that consumers can pretty easily see. So I do think it calls into question maybe some of the outlooks for some of these companies. I think a lot of the CPG companies are going to respond to any decline in demand by pulling back on some of their contracted manufacturing, which they've been adding flexibility into their supply chains and into their manufacturing really since the pandemic began, because they didn't know how demand was going to shake out. And so they added in this higher cost contract manufacturing, which added a lot of complexity to the supply chain. And actually, had some negative impact on margin. So they do have capacity that's higher cost that they can pull back if there really is a decline in demand. So we'll see if they do that. So it's not all bad news for CPG companies. They probably would rather have the higher demand and the higher margin dollars, but they do have some levers to pull, because we're starting out at a level for most CPG companies where their unit volume is higher than it was pre-pandemic levels. Overall, CPG unit volume is about 4% above where it was before the pandemic.
So, Mike, at the end of 2021, we were sitting here kind of speculating, okay, what is going to make the American consumer and even the global consumer stop buying, stop spending on things that aren't necessary goods, but were those I want purchases, not the I have to have purchases. And I don't think that anyone kind of fathomed that a geopolitical conflict was going to be the stopgap, I guess, for the consumer to stop buying things out of unnecessity. But now this is the case, right? You've got people that are now looking at these prices and saying, okay, I can't afford to buy things the way that I was when I had this extra monetary cushioning, and that can offer a little bit of relief on the supply chain bottlenecks. Have you heard of any CPG companies now seeing that as the bright side of things and saying, you know what, okay, this is going to give us a little bit of a breather. We're going to have a chance to catch up because now we are not going to have to be catering to all these intense demands of the consumer saying, I want these goods that I don't need to have, and they're only going to be now focusing on what can I get by with out of necessity.
I haven't heard any CPG companies come right out and say that just yet. I mean, there was this conference in the last week in New York, an analyst conference that they have every year, and most of the companies are just saying, well, it's too soon to know how things are gonna shake out. I mean, I do think that's the spin that they will put on it if we do see a decline in demand, beginning of this year. In the last year, companies were saying, well, 2022 is going to be the year of margin recovery, that we are going to get back those margins we lost in 2021. Maybe that's not true anymore, and it's the margin that they lost in 2021. It's going to take another year or more to fully recover that. But I do think that's the spin that they'll put on it. They'll say, well, there's some cushion because a lot of these items are things people have to buy. At least in developed markets, a lot of people that are trying to cut back will just eat out less and actually buy more CPG. In some cases, I'm not saying it's an inferior good, but there is some of that serves as kind of a natural hedge. I think the companies that are maybe in a little bit more precarious spot are the ones that are really sort of the multinational companies that do a lot of sales in Europe. I mean, you would have to think that the economic impact would be much greater there than it is in North America.
Yeah, Michael, there's there's a fear factor that's kind of going on here, right? And some of these analysts are looking at, and they're kind of drawing that line and saying, okay, we think this is going to happen based on what we know right now, but it's got to be upgraded as things progress or regress, depending on the way you look at it with the situation there in Ukraine. So are you getting the sense that they think that maybe this isn't going to be so long drawn out, that maybe there could be a positive resolution to something here in the near future, and that they're hoping against hope, or kind of trying to hedge their bet as to what they think might be happening?
I think it's the latter. I think they try to hedge a little bit. I mean, there's basically two ways to it. I mean, I was sell side analyst for a long time. I mean, there's sort of two ways to approach a model when things change. You can sort of do it to where you see the news right now and where you see the market sort of right now, and sort of assume that things sort of the changes kind of has taken place and things kind of stabilize from here. Or you can sort of say, well, okay, this is just sort of one signpost on the highway. It's going to change much more than that. I'm going to take my numbers way down, just so this is going to be just one big cut, and there won't be any additional changes. And these seem like more incremental changes, just based on how little they've moved. I mean, I think we'd be happy. Most people would be happy if the U.S. GDP really did grow 3.2% this year. I mean, that's better than most years.
Yeah, I guess the better question, or I mean, it didn't come out the way I really was thinking it was, is more like, because the estimates were as you're saying, they weren't as cut as bad, and 3.3 or 3.5% would be great. Is there kind of like this reactionary uptick in consumer confidence, et cetera, if this were to resolve fairly quickly? Like, hey, we dodged another bullet type of thing, and it wasn't as bad as we thought it was, so let's move on and get with things. It kind of, I mean, everybody's ready for something like that, right? So it could have that effect, or what do you think?
It could. I mean, it's a consumer's been so strong for so long that it's almost like the consumer is priced for perfection, if you will. I mean, the housing market's been so strong for so long. Now there's companies are building lots of houses. I mean, there's really, even throughout last year, just hadn't seen any indicator of the consumer sort of cutting back. So they could go just right back to how they were behaving, before, if there is a favorable resolution that happens quickly.
Right.
All right, Mike, thank you for being with us today. Of course, we've got the Stock Out coming up later this afternoon, and subscribe to the Stock Out newsletter as well while you're at it. We'll talk to you next week.
Okay, see you guys.